Hello and welcome to the latest Insights Live, generating income from your portfolio. I'm Susie Allen, Vice President of Insights from Fidelity Wealth Management. Thank you for joining us today and submitting questions. They've helped shape our discussion. Now, here at Fidelity, we help clients plan for their financial future. And of course, retirement income planning is a big part of that. Today, we're going to talk about assessing how much income you need from your investments, followed by bonds, annuities, managing taxes, and finally, withdrawal strategies. Today, I'm joined by two Fidelity professionals who have spent many years working with clients. Stephanie Zavos, a wealth planner in Arizona, and Justin Bailey, a regional vice president planning solutions in Utah. Now, before we get going, I want to let you know Fidelity does not give tax or legal advice, and nothing we say today should be interpreted as tax or legal advice. The information we are providing is going to be general in nature, and it may not apply to your situation. If you have legal or tax questions about your specific situation, we encourage you to talk to your attorney or tax professional. All right, let's get going. So many of us spend most of our working lives investing for growth, meaning we want to see those retirement and brokerage balances continue to grow. But when people transition to retirement, they often need to generate income from their investments. I want to start with a question we received many times from our clients watching today. So, Justin, welcome back. And how can someone generate income from a portfolio without selling principal?
I'm so glad several of viewers ask this question because I get it all the time. And it does make sense because I think when we start on our retirement saving journey at age 25 and into our 30s, we have this balance that kind of grows up with us. So 30 years later, I have this balance, and as it gets bigger and bigger, I feel better and better about retiring. So I don't want it to go away, right? It's like a best friend that we've had for many, many years. So I think ideally everyone wants to keep their principal and just live off of whatever the income that can generate. Keep in mind when we retire, there's three big income sources that typically are going to pay our bills once our paycheck goes away. The first one, of course, we all know is the government. That's usually going to be Social Security. They're going to provide, obviously, some income if we are eligible, right? Number two, if we're lucky enough to have an employer benefit like a pension, that's going to help pay for our bills. But the third is going to be our personal savings. So this balance that we've been growing over time. Keep in mind, a lot of us don't have pensions. And so if you read what Social Security's website, they will tell you that Social Security really only covers 40% of the average retiree's budget. So 60% is probably going to have to come from this balance that we've created. So a lot of people are going to walk in and say, I want to keep it. And the answer is it's possible, but it's hard. And let me give you an example of what I mean. I had a client a few years ago that came in, was very adamant that, hey, I want to keep my balance safe and I want to live off of the interest. So what we did is we did create, we went into CDs and some bonds. We invested at the time, it was probably earning roughly about 4%. So it was about $1 million. So just to do some math here, 4% on $1 million, that's $40,000 of interest. Combined with his Social Security and a little bit of a pension, it was enough for that first year. The challenge became as we kind of progressed through his retirement, usually about 2, 3 years down the road, well, that 40,000 of interest didn't grow, didn't increase. So there was a point, here we are 3, 4 years down the road. Oh, I need an extra 10,000 now. I need an extra 12,000 now because inflation or the cost of living has basically increased. So that's where the challenge comes in. And he was actually forced to now start to dip into his principal to make that change. Now, on the other side, just to kind of complete this math, well, Justin, what if I were to allocate some more money into the fixed income to hopefully generate it? Keep in mind what that means. If I have 4%, $40,000 off of $1 million coming in, and now what, 5 years down the road, I now need 50,000. Well, that means I need to allocate another $250,000 to my million. So 1.25 million at 4% could generate 50,000. So the challenge is it creates lots of principal has to be allocated to still support that interest rate. So it's a lovely idea and I value it, but it's really hard to do without having other elements to help grow that principal and to try to keep us on track for our cash flow.
All right, got it. So make it last and grow principle. Let's try to work through how to do that. So first, how can someone assess how much income they will actually need from their investments? And Stephanie, welcome. Would love for you to answer this for us.
Absolutely, Susie. Thanks. It's great to be here. And I like to think of when you're heading into retirement, right? Wouldn't it be great if you could feel like you were running towards retirement, your dreams and your goals versus running from work? And so we start with a question of not so much of, do I have enough? It's really about getting to the bottom of what is your true goal? So we start with the essentials, right? Everyone has these: housing, groceries, insurance, and healthcare. But then we start to dive a little deeper than that. And we look at one person's essential could be completely different than someone else's. For example, I have clients who say, hey, if every day was Saturday, right, then we start to look at our life a little bit differently. We don't have to show up anywhere from that 9 to 5. So we think, what are you going to be doing in your extra time? Are you someone who's at the golf club 5 days a week or traveling and spending 6 months over in Europe each year? Or do you enjoy things like hiking and reading? We really start to dive into what's going to enhance your life and what are you going to be doing in your retirement years. Sometimes there's additional goals. Clients have the goal to buy a second home. They want to go to a place they love every single year, or they want to start gifting during their lifetime to see the impact that their wealth could have on their kids, the next generation, or even inheritance, charitable giving. So once we have the vision of what a client's going to spend their retirement doing, then it becomes a simple math equation to help them figure out exactly what they're going to need.
All right, I love that idea of a vision and running to retirement. All right, we're going to take a close look at some income options, starting with bonds. Stephanie, can you give us an overview of the various ways individual investors can access the bond market?
Yes, I like to say there's three main ways that clients can access bonds. The first is probably something you're pretty familiar with, a bond mutual fund or an ETF, which have the general benefits of low minimums, daily liquidity, and diversification with no specific maturity dates. You can sell these at any time, and they're going to kick off that interest to you. The second way is individual bonds or a bond ladder, which allow you to diversify, but it requires understanding the different maturities, interest rates, and credit risk. So in my experience, some investors may not have that type of fixed income experience, which leads me to kind of a third option that really offers a combination of the two, where you want to own individual bonds, but you also want some professional fixed income management alongside that. And we call this a fixed income separately managed account or an SMA. They're more transparent than fixed income mutual funds. With mutual funds, right, you typically only see the reported holdings periodically, whereas a separately managed fixed income account will allow you to see what's in your portfolio at any time. So since you directly own those securities in an SMA, you have the flexibility to exclude certain specific bonds, entire sectors based on your personal values and investing, and know just about what your income's going to be on a regular basis.
All right, Stephanie, thanks for that overview. Let's take a closer look at bond ladders. So, Justin, can you explain how these work?
Yeah. So as Stephanie shared, bond ladders are probably the primary way that professionals will help allocate and spread risk. The whole purpose of a ladder is I'm taking the money and spreading it out over multiple maturities of a fixed income instrument like a bond or a CD. That creates predictable stream of income and managing interest rate risk. Now, what is interest rate risk? We all know that interest rates just don't stay the same all the time. Sometimes they rise, sometimes they fall. When I have my bonds spread out over multiple years, what that happens in the example of interest rates are going up, well, I'm glad I have some short term, maybe a 1 year, 2 year type of duration of bonds because those will mature and I can reinvest them at the higher rate. So I can take advantage of that rising rate as it goes. However, what if interest rates are falling? Yes, those short-term bonds will mature and I'll have to reinvest them at a lower rate, but I'm so glad I have those longer-term bonds, right, that are locking in on the higher rate. So it's a way to hedge both sides, whether rates are going up or lower, so that at least I can take advantage of that. The other thing that you also want to keep in mind is that there's credit quality, right? There's different quality of risk, meaning, and remember what bonds are in general, it's an IOU to pay you back. So they're great as long as you get your money back. So having good quality, and that will range. And obviously, if we have lower quality, they have to compensate us with a higher interest rate. So you need to have some knowledge, some understanding on how these dynamics work. Typically, I think for a lot of folks, they do get professional help, as Stephanie just outlined a couple of examples of how to get that and access that. However, those that maybe are on the safer side, more conservative, maybe we just want to do treasuries and CDs that have more guarantees behind them, and therefore maybe the do-it-yourselfer would be more comfortable to wade in those waters.
All right, Justin, thank you. So let's just sit with you for a second. What's an example of how someone might use a CD ladder in practice?
Yeah, so there's, in two ways. The ladder, of course, helps us to invest in bonds and CDs in general, just as an asset class of our portfolio. But there's another way that you can think about it, and this is what we call a bridge income or a bridge strategy. So, for example, let's say that I'm 60 years old. I'm planning to retire at 65 in 5 years, maybe 66 when Social Security turns on. And out of nowhere, I get reduction of force. I get laid off, early retirement, not my choice. But here I am, I got 5 more years before I was planning, and maybe I can make it work. And so one way to do that in a safe way on this graphic that we pulled up here, maybe I can grab about $250,000. And let's say in this example, I need $50,000 a year of income. I'll take 250,000 and I'm going to spread that out over 5 years. Or in this example, as you can see, $50,000 in 2026, that's a 1-year CD. Another $50,000 in 2027, that's a 2-year CD, so forth and so on. And the point of this is I'm just trying to get from 2025 to 2031 when Social Security turns on, and I know it'll replace this 50,000 and do it in a safe way. So I'm allocating this in a ladder systematically so that when the maturity takes place, let's say at the end of 2026, my $50,000 plus the interest comes into my money market. I now have access to pay for my bills for the following 2027 until the next maturity takes place in my ladder. Now, why would I do this versus just hanging out in cash and just leaving the $250,000 in cash? It's a higher interest rate. So typically we're going to get higher interest by doing this than if we just stay in cash. And remember about cash, the purpose of cash, the primary purpose is liquidity. I don't need all 250,000 today or next 6 months or 12 months. I'm going to need portions of it in 2 years, 3 years, 4 years. So let's allocate it out in a ladder to get and lock in on those higher rates and then have the liquidity happen at a strategic time frame.
All right, Justin, thank you. Let's bring in inflation now into the equation. It's been slightly increasing recently, though it's not as high as it was a few years ago. But should inflation continue to increase, what would that mean for income investors?
Yeah, this is probably one of the biggest issues that we have in retirement when we're trying to derive income from our investments. And I know we're all feeling more interest or more inflation out there. We're all in this together, I guess. But at the end of the day, here's what the impact, especially for more conservative investors that are using bonds to generate this income primarily, there is a thing called a real return. So what I mean by that is that, let's say, again, I'll keep using the 4% just as a round number here. My bond portfolio is generating 4%, but inflation is at 3%. The net difference or the real return of the bond is actually 1%, right? It's the 4 minus the 3. And that's what my money is really making. Now, the question would be, is 1% real return enough to stay ahead long term of probably future increases of inflation? Likely not. So this is where the more conservative investor that is really heavily more in bonds, inflation can take a bigger bite out of the return and just make it that much harder to stay ahead.
All right, Justin. All right, last question, last follow-up here, and I'll let you off the hot seat. So, what are the options for investors who may be seeking a higher yield? You talked about conservative investors, talk about a higher yield situation.
Yeah, it is a hot seat, but that's okay. No, so let's try to see, well, what are the options to try to get a higher yield? And this is where, again, we're more conservative investors are probably more focused on principals. But if we venture off to maybe some higher risk to our principal, but we should be compensated by a higher cash flow or higher dividend or interest. So let's hit on a couple of these. Probably the one I get asked about the most is a dividend paying stock. So there are above average, and what I mean by above average, the S&P 500, the largest 500 companies in America, when we look at that aggregate index, it's about a little over 2% dividend. So when we're looking at stocks that are paying above that, that's what we would say above average. So if I'm finding a stock at 5%, wow, that's nice, right? I'm getting 5% interest off of the company. However, we are now shifting this where my principals now owns a stock. The stock is going to fluctuate, not based on, of course, where the dividends are, but where the earnings are. And if they have a bad quarter, the stock might go down. So my principal is going to start moving, even though it's going to pay a dividend. And hopefully it moves on the upside. That would be the best of both worlds. Good dividend, rising stock price, but we know that stocks don't go in a straight line. So we have to accept a little bit of that fluctuation taking place. The other thing about dividends are not this contractual guarantee or a contractual obligation like a bond where there's a stated coupon rate. They will pay the dividend based on the ability to pay it. So, and this is why doing some research, understanding the history of the company, and it's not just that they have a history of paying dividends and increasing dividends, because dividends can be cut at any time for a variety of reasons. It's really the financial strength and the future and the earnings of the companies. Now, that's one area. Another area would be high yielding bonds. Now, high yielding bonds, these are corporate bonds. These are, of course, companies that typically have a lower credit rating that typically, one or all of the rating agencies give it. So it's not as high quality. There's a variety of reasons why. Maybe they have a lot of debt on their balance sheet. Maybe they've struggled in certain areas, and they have to pay a higher interest rate in order to attract that. Now, again, there's more risk here. Bonds are only as good as the ability to pay you back, right? And so I love it when they're paying us back, but we should diversify. I would never own just one or two or three companies. You should diversify, and I probably would use some professional help on this that does deep analysis with their credit and with, of course, with the financials. A couple things that I'll round out here that I'll always hear about: preferred stocks. Preferred stocks is this hybrid between a stock and a bond, meaning that it's not actual ownership of the company, but they issue it out at $25 a share. There's generally a stated dividend that it pays, which is of course above average. But also, even with preferred stocks, if the company falls on hard times or a crash crunch, they can reserve the right to not pay the dividend. Now, they typically would go into what's called arrears, where I will owe it to you later when our cash flow comes back, is kind of how that goes. So again, there's some risk. It's not necessarily always reliable every single time. So again, analysis is really important. And then the final one that I bring up that I hear, real estate. So real estate investment trusts, having a portfolio of real estate, which of course, as we know with real estate, we get leases and rent payments. So there's a cash flow element that can also pay a higher than average dividend. But of course, not all real estate's equal. So getting some help on that. And really, I would suggest, whether it's through our mutual funds or, as Stephanie shared, the separately managed accounts, we have professionals that are experts in all of these areas that can help with the diversification of the risk. Can't eliminate the risk, but diversify it and manage it appropriately. And the one common thing that you'll probably heard me say here, it's all based on the company's ability to pay you back. So it's not oh, this is a great, they paid a dividend forever. I'm always, what's their earnings? How are they investing? How good is the management? This is not something where we set it and forget it. We do have to pay attention to that because the health of the company will always back these things, and that can change over time.
All right, Justin, those were really great considerations. Thank you for that. You mentioned REITs. We actually received several questions from clients about those. So Stephanie would love for you to talk a little bit about the role REITs play in a portfolio.
Absolutely. And we get this question all the time as advisors. So REITs simply are just companies that own, operate, or finance real estate. So when you buy a share of a REIT, you essentially become a partial owner of the REIT's underlying properties. So a REIT by nature must generally invest at least 75% of its assets in real estate. And this is where the income piece comes in. They have to pay out at least 90% of the taxable income annually to shareholders as dividends. So one way that clients can access REITs is through publicly traded REITs, and they come with a number of potential advantages like lower minimum investments versus having to have enough capital to go out and buy real estate yourself, as well as diversification beyond just traditional stocks and bonds. It is important, though, to be aware that dividends are not guaranteed with these investments, and a REIT can always reduce its dividend payments. So if you're going to invest in individual REITs, you really want to do your homework to understand them and choose the specific investments that may be right for you. Changes in real estate values or even economic downturns, different laws can change around the real estate world that can have significant negative impact on issuers in the real estate industry. So it's really important, again, to do your homework or work with an advisor to better understand each of these investments.
All right, thanks, Stephanie. I'm going to stay with you for a moment here.
Sure.
You talked about cash a little bit. So interest rates have come down since the peak a few years ago, but cash remains another potential source of income. And many of our clients still have a lot of assets in cash. I think Justin mentioned this earlier. So how might someone determine an appropriate level of cash holdings?
Yes. So Justin had mentioned the basics of this earlier, but really remembering the purpose of cash is liquidity or immediate access. If you get any interest, right, that's kind of a bonus in our world. In general, we recommend that a client have 3 to 6 months worth of their essential expenses set aside in cash. And this is really designed for one purpose, to cover essential expenses such as mortgage, groceries, healthcare, childcare, or even debt payments if you have an unexpected event, maybe job loss or something to that effect. Right? It can also make sense in some cases to hold additional cash for a secondary goal that is a one-time event. Let's say you have a child getting married and you know that's happening in the next 12 months. So maybe you have a little cash reserved for that specific goal. But what I find is a lot of clients have more than just their emergency fund, that 3 to 6 months or short-term goal expenses sitting in cash. And from that standpoint, one of the risks that we forget, right? Because as humans, it feels good to look at our, checking and savings and say, hey, I've got this guaranteed amount. It's not changing, it's not fluctuating, and that feels good to us. But what Justin mentioned earlier, that real rate of return, when we think about your purchasing power of what those dollars could do for you, it generally is eroded each and every year as time goes by from that inflation piece, especially in an environment that we're in right now. So I want to reiterate that an effective way to kind of help manage inflation longer term is going to be a diversified portfolio of stocks and bonds and cash, right? But if you consider the real rate of return, it's going to be really important for you to look at not only your short-term goals, but also longer term and how your cash holdings may hold you back from a nice longer term environment.
All right, Stephanie, thank you for that great perspective on cash. Let's dig deeper into annuities. Many of our clients have questions about annuities, and to be honest, some are skeptical. So let's level set. What options are available for clients interested in annuities? And Justin, bring you back into the fold here.
Yeah, they should be skeptical, because there's a lot of different versions and varieties out there. So I want to kind of cut through this and just level set on when it's adding value for income and when it's not. At its foundation, there are two types of annuities. So just clear, if we cut it all through, there's only two. One is what we call the variable annuity. And the variable annuity, the variable part is we can place money, put it into a contract that will be tax deferred, and it'll invest in, something similar like a mutual fund. And the point of it is to grow over time or vary up, right? So that's the point of it. We're not talking about that one. So can I set that aside? Because the second one is what's called the income annuity. And the income annuity allows us to convert some of our retirement savings into a reliable pension-like income stream. And so that's why I want to pull up a visual here, because really underneath it is actually something very similar we've been talking about. It's bonds. Okay, so let me walk through these three colors here so that everyone's aware of what we're talking about. In the blue, the light blue and the dark blue, that's a bond ladder. And what's happening here, because income annuities do pay significantly higher cash flow, right? And how do they do that? Well, they're not magically going out there and buying bonds that magically give high interest rates. They have the same interest rate. What they're doing is that light blue is the interest off of the bonds, and the dark blue is the principal. So it is a bond ladder that is maturing, and I'm getting both principal and interest back. And because both of them, I'm getting a significantly higher payment. Now, you don't need to do an annuity to do this. We've been talking about bond ladders. We can help you invest and kind of do a bridging strategy bond ladder. But then this is where the second risk. So I talked about inflation being one of the biggest risks for retirees' income. The second one is, when are we going to die? That is, and nobody knows, thankfully. Oh, thankfully we don't know that. I don't want to know. But if I live a long time, I need my money to generate income for a long time, and that could put stress on it. So that's where this yellow part comes into play, because in this particular example, we're basically spending down the bonds to basically our late 80s there, and then it's zero. And then what if I'm still kicking really well? What do I do? That's where, and on the chart there you see it says it's a longevity bonus or a mortality credit. Let's just call it the insurance company comes in and covers you. And that's where that yellow part comes in. So in my mind, the more yellow you get, the better the situation is. And the more I can feel safe that it's okay, I can spend down that principal, or i.e. have that higher cash flow, because I know that I have an insurance company that has my back, that I can live hopefully all the way past 100 and collect lots of money from the insurance company. So that would be the intent. So the pros of this is higher than average cash flow. Also, the insurance company guarantees all this. Now, we always have to remember, we got to pick the insurance company right, because the credit, the claims ability of the insurance company backs this. So I always want good, high quality companies. And then I can spend, and I don't have to worry about running out of money in that case. Now, there are some cons that I always want to highlight, because there's always trade-offs. Number one, most of these don't have a cost of living adjustment. You could add it, but that would, discount the cash flow a bit. So people typically don't do that. So there is, again, inflation's going to erode this away. So this would never be my only solution. I have to combine this with some other element of growth. Number two is the other concern that I get a lot. Well, Justin, what if I die early? What if I buy it and I die at 70 or 75 and my money goes up in smoke? Yeah, I don't want that to happen either. So typically I'll always suggest to put what we call a beneficiary option, where I protect the beneficiary, meaning that if I pass away early, unanticipated, that remaining balance will go to my heirs, either in the form of a lump sum, minus any, of course, the withdrawals I've taken on that, or the cash flow, or continue the payment for my heirs. I also always would protect, if I have a significant other in my life, I might have them as a joint. I want to protect them and make sure that that payment would continue on after my passing. So all of these extra benefits can be added to ultimately protect that. But this is something that we should review because it does provide that higher cash flow with definitely with lower risk, and it won't run out, especially as we all hope to live to over 100, right?
All right. Well, Justin, thank you for covering the what. Since we're all kicking it really well right now, how can someone decide how much of their portfolio to annuitize?
Yeah, that is a very important discussion because the other part of the annuitization is once I annuitize, it's permanent. Just like when I sign up for Social Security and start it, that's permanent. When I start getting payments from the pension, that's permanent. They're all permanent. So we want to make sure that we've done our research and talk this through. So the starting point on all of that, and Stephanie alluded to this earlier, we still got to start with your hopes and your dreams and what kind of budget that's going to support. And so we're always going to start with your budget. What is your true cash flow needs? And figure out what is essential and what is truly discretionary. Now, the hope is with the essential amount, I have enough Social Security and pensions coming in to cover the essentials. And then I don't have to worry, do I need more that I need to allocate towards annuitization? But for a lot of us, we just don't have enough that's going to cover our essentials. So that would be our starting point, that we maybe need to allocate more money to give us that guarantee to at least no matter what, my essentials will be covered. One thing to help us with that is Fidelity has financial planning software. Hopefully some on this webinar have already used it and are actively using it, but we can go through a spending budget, project a cash flow roadmap for you. Obviously, we'll add inflation and some market returns and so forth, but let's just lay it out of how your expenses would look over the next 30 to 40 years. Also part of this software, we're able to do scenarios. What if we were to add another 2,000? What if we added another 4,000? And just get your feedback, because the other part of it, that's the math and the science, but I like to do scenario planning just so that I get your preferences. What do you ultimately want? There's a point that the math has to stop and you have to come in and really share what you feel, what's important to you. So this is a very interactive. I'm not going to say Justin Bailey has the answer because you actually have the answer that I'm just going to try to pull out of you through this process. So it's important to work with your financial consultant on that.
All right, Justin, thank you so much. And I'm pulling out the answers from both of you. So we've been talking about income generating investments, but in many cases, earning income means paying taxes. We talked about, we hinted at it earlier. So let's talk about it a bit more. What can help manage taxes on income investments? Stephanie, open it up to you.
Absolutely. So one of the things that you want to start to understand is how our investments are taxed in different account types. So that's really going to be key to managing your taxes overall. We call this concept asset location, meaning what is the location or account registration type that you're purchasing the investment inside of. And I believe we have a visual on this one as well that I want to walk through. So you'll see there's kind of three main categories. Taxable accounts, think of trusts, joint accounts, individual accounts. Your tax deferred accounts, those are your 401ks, 403bs, IRAs, and then tax exempt. An example of that would be your Roth account. And each of these will hold investments and it sort of controls the way that they're taxed. So let's start with that taxable column. A couple of good opportunities there are to invest in municipal bond funds. That's a great place to hold them is in that trust or joint account. Because ultimately, if you are in the 24% marginal or higher tax rate, you're probably going to be better off holding municipal bonds because of the federally exempt interest, and in some cases, state and local as well, depending on the issuer state. Another option is stock funds that you're holding for longer term growth or even stock ETFs. So these focus generally less on dividends and more so on that long-term growth where you control the capital gain. You control when you sell it. Generally holding more than 1 year is going to have more tax favorable treatment on a capital gain as well. Some of the things that would be generally less appropriate for a taxable account is high turnover mutual funds. This is where the manager's objective is maximum growth as quickly as possible. This is more tactical funds where they're moving in and out of positions that can create capital gains over time, as well as things like corporate bond funds generating that interest that you're going to pay tax every year on that 1099. So those are just some examples. As we move over into the tax deferred or even the tax exempt space, it's less appropriate to hold municipal bond funds. You already have the advantage of tax deferral with both of tax deferred and tax exempt accounts, like IRAs or Roth IRAs. So it's less appropriate to hold those type of funds. And generally, you want to hold those high turnover funds, or if you're looking at bonds, corporate bond funds are going to be most appropriate because we're deferring the tax on that interest payment.
Right, helpful chart and helpful overview. Thank you. Let's talk about clients having a mix of different account types, and we see that frequently. So taxable brokerage, tax deferred, tax free. Justin, wondering how should they decide how much to withdraw from each?
Yeah, let's build on that because that asset location is really important for tax efficiency of growth. But what happens when the withdrawals come into play? So again, the reason why we're paying attention to these three account types is because again, the capital or the taxable account has capital gains typically, right? So that's going to be a lower capital gain rate than ordinary income. Of course, our IRAs, 401ks, 403bs, all these pre-tax retirement accounts, when the money comes out, it's ordinary income. And then, of course, with the Roth, as we take that out, as long as we're following the rules, there's a 5-year aging rule and we're over 59 and a half, the Roth will be tax-free. So if I'm going to start to withdraw, let me give a couple of examples. Let's say in this example, I'm just going to withdraw by account and spend down the account, then move to the next one. So if you notice here in the blue, I'll start with my taxable account. And I've seen some clients do this, by the way. Well, it's a better tax rate. It's a capital gain. I'll spend that down, which helps us on the taxes, right, in that blue, and we'll withdraw that for that 4, 5, 6 years. But then the account goes to zero. Now they transition into my pre-tax, and that's where those green lines are. And if I'm just only withdrawing from my IRAs, that's all taxable. And if you notice how the lines bump up on top, you also see how on the very bottom those dark green bump up. That's because it's fully taxable. I have to withdraw even more to pay the tax on the very taxable distribution that I'm trying to generate income, right? So we can, I call it a tax bump right there, where we have higher taxes. And then once we spend those down, and sometimes RMDs generate that, then eventually when that goes to zero, I do have my Roth left. And I tend to find people leave the Roth alone because they love that tax-free growth. Let's try to get as much as we can, and then we eliminate the taxes. So the issue here is my taxes are kind of all over the place. They're low at the first, they jack up, and then at the end, I have less. What if we were to layer this? So go to the next slide. What we're looking at here, I like to call this the layer of a cake, the tax cake, right? And so what we're doing is that blue, of course, we're going to still draw some of our money from our taxable account so that we can take advantage of that lower cap gain rate. But also at the same time, let's start taking some money out of the IRAs. And oh, Justin, but I can defer it later. Taking out maybe early, maybe in our 60s when we retire. What we're doing there is notice how we're spreading it out. Spreading the taxes. I like to call it, it's like peanut butter. We want to spread it out. And because it's better from a tax liability to have multiple tax years where we spread that out. And then if we still need a little bit more, there's a point that I don't want to totally withdraw everything, all the rest in the remaining from my taxable account. I add maybe a little bit of Roth on the top. I call that the icing because it's tax-free, everybody. It's the sweetest part of the whole deal, right? What am I doing? If you can see those little bars down at the very bottom, we're just keeping the overall tax liability even across multiple times. Now, how do you do this in practical? You work with a tax advisor, ultimately sitting down and saying, where am I in my tax bracket? And if I'm in a certain tax bracket and I have a little bit more that I can withdraw from my IRA before I bump to the next bracket, then let's do that. And then for the next bracket, maybe that's when I'll pull my Roth in to help me back. So there's a little bit of planning. You probably need a little bit of professional help to help spread that out. But ultimately, the layered cake would be sweeter than just the tax bump.
All right, withdrawal strategy, tax cake. Sounds delicious. What an analogy. All right, a lot of clients are obviously concerned with taxes on retirement income. So, Stephanie, talk to us about strategies that are available to help.
Absolutely. In addition to the strategy that Justin just laid out for us, another popular one is the Roth conversion. You hear people talking about this a lot nowadays. A Roth has several advantages, right? Including tax-free withdrawals. Again, if you hold for 5 years and you're 59 and a half, there's no required minimum distribution on a Roth during the owner's original lifetime. And there's also potential for tax diversification with this strategy. So whether or not this is a good idea for you specifically is going to depend on a few factors: your retirement timeline, your current and future anticipated tax brackets, your overall estate planning goals, as well as your current cash flow. So let's talk about when you intend to retire, right? For many people, maybe they've started an initial Roth contribution that satisfies that first 5-year aging period, required to withdraw those earnings tax-free. But what we need to think about with Roth conversions is each conversion will have to be withdrawn first, and they have to meet their own 5-year aging requirement, or you can run into a 10% penalty in some cases. So you want to really map this out. Again, bringing in your financial consultant and tax advisor are going to be two representatives that can help you work through this. The second is, are you prepared to pay the taxes now? Some investors may be able to offset some of their liability on a Roth conversion, either with charitable giving or tax deductible losses, but most will need to pay it with cash on hand. So if you have to tap into the assets you're converting or sell other investments to cover the bill, it may not be worth the trouble. It is ideal to pay from a taxable account. And so that's something that you want to make sure that you have enough cash on hand to be able to cover those tax bills as you move forward with the strategy. And lastly, if you anticipate that your income may decrease significantly in a future year to reduce your marginal tax rate, you might consider postponing a Roth conversion. Let's say you're still working, you're making good income, and you know your tax bracket is likely going to shift down after you retire from that lower income and before maybe you start Social Security or turn on a pension you have from an employer. That could be a nice little window to explore this strategy potentially during those few years where you may be in that lower tax bracket. So similarly, though, if you expect your tax rates to rise in the future, a Roth conversion this year could make more sense, right, than when converting for future tax brackets. So you really want to evaluate kind of year by year and estimate. And this can also be done a little bit with some cash flow planning and working directly with your tax advisor or CPA.
All right, Stephanie, thank you for that. Now, I think what I heard, starting early is always a great idea, but for many of our clients, what if you're already taking RMDs?
Absolutely. So if you're already required minimum distribution age, you really have 3 options at this point. You either spend it, you gift it, or you reinvest it. So if you're going to spend it right on yourself, which is fine, take those vacations, have some fun, you're going to pay some tax on those required minimum distributions. Okay. Number 2, though, if you choose to gift it, you can either gift it to people in your life or gift it to charity. Now, if you gift it to someone that you love in your life, make sure they thank you because you're going to pay the taxes on it and they're going to spend it. So again, doesn't give you the tax savings there. But if you are thinking about gifting to charity, you can use something called a qualified charitable distribution. So think of this as, normally, let's say you're writing a check either from Fidelity Charitable or just you're writing a check from your checking account, right? But what you'll want to do here is actually write that, so to speak, from your IRA directly. You can gift up to $111,000 a year directly to reduce your taxable income. And so that's kind of a little known opportunity to help reduce that RMD amount from a tax perspective. You still have to pull it out, but some of it's going to charity. And so that's a good way to kind of offset a little bit of that tax or try to keep yourself in that lower tax bracket as your required minimums potentially would go up most years. The third one is you can reinvest it. If it's coming out of the IRA, again, you're going to pay tax on it. But if you don't need it or you're not going to spend it, this is where tax efficient investing can come into play in a non-qualified account like a joint or a trust. So then you reinvest that money and then you start to do some of the tax efficient strategies that we've talked about before.
Amazing. All right, we've covered a lot. So what's a good asset allocation approach that can help balance growth and income needs in retirement?
Absolutely, Susie. You know, a lot of times we see clients think, okay, I've arrived, I'm at retirement, right? What should my asset allocation be today? And it's common to think that. They often think, oh, I should be really conservative, right? And when we start to really map it out, though, if you retire at 60 or 65, you still may live another 20, 30 years, right? So not only is this the starting point of your retirement, but you've got kind of a long way to go potentially. So it's critical to also continue to invest for growth, at least with some portion of your assets. If you get too conservative too early, you can run the risk of having inflation diminish your purchasing power that we talked about earlier and potentially not be in a good position to cover higher healthcare costs or even long-term care down the road. Those are things that it's important to think about and plan for. In reality, we need to consider your goals, needs, your preferences, time horizon. We'll talk to you about comfort with risk and fluctuation, your overall financial situation to really determine what the best allocation for you would be. But I will say, if you do have your essential expenses covered, either through a pension, through work, Social Security, some type of income annuities that Justin alluded to earlier, the rest of your portfolio can more confidently be invested in growth assets for those discretionary investments. Think of it this way. If the market goes down, you might choose to skip out on that lavish vacation in a particular year. But also, if the market goes up, then maybe you take out more, right? You think about that 4% rule, but when the market's doing well, maybe you take some of those gains and do something that's really important to you and your family. So the balance is aligning your expenses and lifestyle to the right combination of investment solutions. And overall, Susie, I think the best allocation is really what's customized to you. Just like there's no single best allocation and there's no single best investment.
All right, well said, Stephanie. Thank you so much. And thank you to Justin as well. Thanks to both of you for such great insights on this important topic. Want to wrap with a few key takeaways from our discussion. So first, build a reliable income stream. For example, bond ladders and annuities can be used to generate predictable income and cover essential expenses. Secondly, invest for income and growth. A diversified portfolio can help maintain growth potential and protect from inflation. And lastly, we talked about tax smart withdrawals. So make tax smart withdrawals. Different withdrawal strategies can be implemented to help reduce taxes on retirement income. Think of Justin's cake analogy here. All right, we hope you, our viewers, have come away with lots of great income investing ideas. Please join us for our next Insights Live webinar on early retirement. In the meantime, reach out to your Fidelity representative to have your specific questions answered. And for more timely market updates and insights on other financial planning topics, subscribe to Insights from Fidelity Wealth Management for exclusive invitations to future wealth management webinars and access to our weekly newsletter. Thanks again for joining us.